I was expecting a pretty calm week for stocks this week. And this morning, I was pleasantly surprised that Chinese stocks had really rallied. I own Alibaba stock, and it really went up a lot, over 7% today. What's going on in China? Why are stocks really going up? Well, the answer is the government is really beginning to stimulate the economy in a couple ways. First, they copied the US and they lowered interest rates by 50 basis points. That really helped create the rally. But they're doing additional things to help their real estate market. That's really helping the country. I also believe that the economy is really being unbound by the COVID restrictions they had a couple of years ago. A couple of years ago, the Chinese government really had a harsh way of shutting down economies in order to prevent the spread of COVID. And I'm not here to question or debate whether that was a good idea or bad. I'm just calling it from an economist viewpoint as a fact that they shut down certain industries. And that was quite disruptive to those economies and those companies. So that really slowed down growth for a couple of years. Well, we're past COVID now, and I think the restrictions are gone. The Chinese government is not going to shut down markets, it's not going to shut down companies in the foreseeable future. So that's really positive news. I think that combined with a government that is going to try to help its economy and help companies really start to grow is really good news. I think that's why the market really rallied. Now, is this the beginning of something bigger? I hope so. I think it makes a lot of sense for Chinese stocks to be valued more. What I'll do in this video is I'll give you some more economic data that shows where the economy of China is today and where I expect it's going to go in 2025 and 2026. Also, take a look at a few companies that I'm interested in, leading with Alibaba, which is a company I'm an investor in and have a lot of analysis on, but also talk about a few other companies that are interesting. And really, I'm really starting to watch Chinese companies at this point. I think a lot of investors are after a day like this. So let's get into it. Let's take a look at some more economic news and information on China. Let's look at the GDP growth rates for China and compare them to the United States. So it's expected China is going to grow in 2024 by 5%, which is a very fast growth rate compared to the United States is far lower. And I'll show that in a minute. And for 2025, it's expected China is going to grow at 4.8% and 26 by 4.9%. Very good growth rates. If we look at the United States, we're growing far slower. In 2024, we're expected to grow at 2.4%, less than half the growth rate of China. 25, we're going to slow down to 1.7%, far less than China. And that's one of the points that I make with Chinese stocks. They're part of an economy that's growing faster. That may be a big opportunity for Chinese companies. Chinese stocks over the last 3 years have underperformed the US stocks. But 5 years ago, they were tracking along with US stocks. So let me show that to you, and then I'll try to explain what I believe is the big difference. So back in 2020, I'm comparing a large ETF of large Chinese cap stocks compared to the Dow Jones, which is made up of 30 large cap US stocks. And they were tracking around the same range up until the beginning of 2021. So from 2020 to the beginning of 2021, these were pretty much close to each other. But at that point, you saw a big separation. And in 2022, there was clear separation. And after 22, stocks in the US really recovered. But in China, they just stayed very suppressed. So that big difference being, I believe that the Chinese economy was really shut down due to COVID. And the Chinese government decided to really have more intrusive measures where they would close down companies, close down economies. That really made a big difference. There's also, I would say that there was confidence loss in Chinese stocks to a large extent. So those pieces really ended up discounting stocks in China quite a bit. Now, more recently, over the last month, Chinese stocks have really done well. Is it the beginning of something that's going to last? Well, I'm going to keep track of Chinese stocks because if it is the beginning of something, there's a lot of room for Chinese stocks to run. You see that they were very suppressed and probably discounted by a wide margin. And I'll take a look at some individual examples of companies and show you how discounted I believe they are. A stock that's really working right now is XPeng, symbol XPEV. This is an EV company that is growing very fast. And the latest news has the stock going up 52% in a month. Incredible. But if you look at the 1 year return, the picture is not as pretty. It's down 35% over the course of a year. So you can see this stock's really rebounding from a really low point. When you look at their growth, it is pretty incredible. This is in the Chinese currency. Again, you have to multiply times 0.14. But the growth rate on a very large company, 72%. Eat your heart out, Tesla. That's an awesome growth rate. Chinese EV makers have a lot of strategic advantages, one of them being a lower labor market. A lot of the materials that go into cars to begin with are manufactured in China. All the components are there. So there's a lot of advantages there. And I think XPeng has a great opportunity around the world where you have countries that are building out their middle class. And that middle class wants to buy a $5,000 or $10,000 EV car, as opposed to what Americans are accustomed to, spending $40,000 to $60,000 to $100,000 on an EV. So it's a great opportunity for XPeng. And that growth rate looks exciting. This is a company to keep an eye on. I'm going to keep an eye on it. I'm not a big fan of car companies, but this one might be an exception. I'm going to follow it for a little while. Another way to invest in China would be to use an ETF. In this case here, this is the iShares China Large Cap ETF. And it's really beaten down. If you look at the 5 year, it's down 25%. And it's more recently really caught fire. It's really up 15%. Is this one going to keep rallying? Maybe. If the news continues to be positive around China, boy, I'm going to keep an eye on this ETF, maybe buy some shares, because there is pretty good upside because the stock's been suppressed for a while. BIDU is a really neat company. They're a lot like Google here in the US, except in China. They do a search engine along with related businesses, and they have a market cap of just $33 billion. The revenue is really healthy at $18.5 billion. Net income, they're profitable. Geez, good stuff. PE is way down at 11 for the current year and 8 for the forward. Holy smokes, looks really good. Analysts think it's really discounted. So this really looks like a stock worth looking at and keeping an eye on. This could really go places. It's been up in the monthly chart. When we look at the 1 year, you can see it's down 28%. Over 5 years, it's only down 7%, but we're missing a real big rally in between then and now. So overall, this is one company I'm going to keep a close eye on is BIDU and see if this might be worth investing in. Again, the whole story around China has to continue to have favorable news. But if that story is intact, there's a lot of really good looking companies in China. And the final company I'm going to look at is Alibaba. And I'm going to give you a full analysis of Alibaba since it is a stock that I own. And I have a lot of analysis and history with this stock. So today it was up 7.88%. Excellent. Very good to see. Over the last month, it's up almost 14%. It is a big cap at $226 billion in market cap, $130 million in revenue. It's profitable, has free cash flow, and the PE for the current year is 25, but next year it's going to drop down to 10. That's awesome. They pay a nice dividend. Analysts think it's a strong buy, but it only offers up a modest discount. When we look at their growth, they continue to grow. And keep in mind, the Chinese economy was sputtering for a couple of years. So it's good that they were growing. And now that the economy is going to begin to expand, I think it's going to be really good for Alibaba. Balance sheet's excellent because they have more cash than they do debt. Very good sign. And they generate excellent free cash flow that I'm going to show you in my model. The forecast is very good. 16 analysts cover the stock, and they have a favorable opinion on the stock. Now, let me jump to my model because that's where I've converted all their financials from the Chinese currency to the US currency. Overall, I think the stock is discounted by 45%. When I discount the free cash flows the company is going to produce over the next 4 years, along with all cash flows beyond year 4 and terminal value, and I discount those free cash flows by 10%, which is higher than their weighted average cost of capital, which was only 8. But I added 2 additional interest rate points because I want a higher return, higher risk out of my home country. I want a bigger return for my capital since I'm taking a higher risk. So when I discount all those cash flows by 10%, I get $267 billion. Add cash, take away debt to get to what I call equity value. That's what the company is worth to me, $296 billion, which is higher than the current market cap by 31%. So a nice 31% discount if we look at the cash flows that Alibaba is going to produce. Earnings per share is very favorable. Converting it to US dollars, it's $8.97 per share. PE of 18, which is reasonable. This is a growth company in a very attractive industry, but it's in China, so it's not going to get a 25 or a 35 or anything like that. Modest growth to 5%. They'll probably exceed that, but I'll be conservative. Even with those conservative numbers, as a discount of 74%. So looking good. When I combine the two, I get a 45% discount on Alibaba. Alibaba is a very attractive and desirable company for my portfolio. First, I like investing in China. I think it's a high growth market. I think it's going to be eventually the biggest economy in the world. There's a lot of good things going on in China. In addition to that, this company has gotten very large and it has competitive advantages against its competitors. It also has some innovations that are really desirable. Really resembles Amazon in a lot of ways, including its dominance in China. I really put it mostly in the green of my desirability quadrant because most of the factors that they have form a very good competitive barrier against competition. Their size, their geographic location. I don't think Amazon can compete with Alibaba. They have the advantage there. And I put them slightly in the gray as well because it's outside my home country. So it's not a perfect fit for green, but it's a desirable company nonetheless. When I look at the performance of the stock, it's doing well. I'm making 22% return on my investment. There's a lot of upside in this stock. Overall, I own $38,633 of stock and I invested $31,638. So overall, right now, we're in the green on the stock. It'd be nice for this stock to really start working. It'd be nice for this stock to go up maybe 50% over the course of the next 12 to 18 months. We'll see what happens there. What am I going to do with this stock? Well, I'm going to hold. I want to keep collecting more information on China. China's certainly having a good week, but I want to have a couple of good weeks, solid, good information, good interest in China. I want to see some Alibaba stock begin to rally, and I might buy more shares. And I might add another one of the stocks or the ETF that we covered earlier as a secondary investment in China. But I'm going to give it a few weeks. I think our stock market is expensive. Wouldn't be surprised if we had a solid sell-off. So I want to give it a little bit of time before I jump in with additional capital into Alibaba, as well as putting capital into another Chinese investment. So that's my video on Chinese stocks. Really exciting news for them. In a way, I'm glad that these quality companies are beginning to work because they do have really big importance in the global economy. They produce products or services that really help a lot of people and are really needed in the regions they operate in. So it's good to see that. We'll see if they can keep it going. I'm certainly going to be watching it because it is an area that could really see a lot of capital rotated into. You see the stock market in the US being really expensive. Well, if China gets exciting, it could pull a lot of those AI dollars. It could pull a lot of these technology dollars that are in very expensive stocks and really attract some investment that wants to get that growth at a discount. We'll see what happens. Everything I share with you is just my individual journey as an investor. None of it is financial advice. It is all for educational and entertainment purposes. I hope you found it interesting, and let me wish you the best of success in investing in 2024.